This is a bookbull summary of the book Unshakeable by Tony Robbins and Jeremy Bobb. As a 20-something, just getting by might feel like an accomplishment, but what about your future? You can't rely on part-time gigs forever. So, how can you ensure financial security for your future self? The authors suggest starting saving and investing now, even if it's just a little. Your future self will be grateful. Further, you will learn more about how you can do it and where you can get started. Number 1. Start investing early with compound interest. Investing can seem overwhelming, but it doesn't have to be. By recognizing patterns in a financial market, you can make informed investment decisions. One pattern to pay attention to is compound interest, which adds value to your investment over time. That's why it's crucial to start investing early, even if it's just a small portion of your paycheck. For instance, if you invest $3,600 annually from the age of 19, with a 10% average return rate, you could have over $106,000 by the age of 35. But if you wait until the age of 27 to invest the same amount, your investment will only amount to around $53,000 by age 35. Starting early can make a huge difference in the long run, so don't wait. Moreover, if you're just starting out, you may not have a lot of money to invest, but don't let that stop you from getting started. Even a small amount of money can grow substantially with the power of compound interest. That is the miracle of compounding. By setting aside just a few dollars a week, you can make a significant impact on your long-term financial well-being. Number 2. 4 core principles for safe investing. If you're finding this video to be enjoyable, show your support by liking it and subscribing to my channel for even more fantastic content. Your encouragement means everything to me and drives me to keep creating videos for you. Investing can be tricky, especially for beginners. But expert investors have developed a set of principles that can guide you towards safe investments. The first principle is to focus on avoiding losses rather than earning big gains. Even though nobody wants to lose money, investing involves risks, and it can be difficult to earn back money that's been lost on an investment. To avoid losing money, prefer safer investment options that have a limited downside. Another important guideline is to remember that even the most experienced investors can make mistakes. No one can predict the financial markets with certainty. For example, Ray Dalio, a superstar of the stock market, learned in 1971 that it was impossible to predict market outcomes. Therefore, to avoid losses, experts make investments that are robust in the face of unexpected market events. By following these 4 core principles, you can make safer investments that will protect your finances in the long run. Number 3. Investing 101. Balancing risk and reward. When it comes to investing, taking big risks for big rewards isn't always the best approach. In fact, successful investors often prioritize minimizing losses and seeking out investments with asymmetric risk-to-reward ratios. Take Paul Tudor Jones, a highly respected trader, for example. He follows a 5-to-1 rule, only investing when he expects to earn at least 5 times his initial investment. By doing this, he can afford to be wrong 80% of the time and still break even. Another strategy for success is to invest in undervalued assets, especially during a market downturn. For example, after the 2008 financial crisis, Citigroup stock plummeted from $57 to just 97 cents per share. However, within 5 months, the stock price had increased by 500% to $5 per share. Remember, investing is about finding a balance between risk and reward. By following these principles, you can increase your chances of success and achieve your financial goals. Number 4. Knowledge of taxes can boost your returns. Investing can be a great way to grow your wealth, but taxes can eat up a big chunk of your earnings if you're not careful. That's why it's important to know your taxes and make decisions that will minimize their impact. Here are some tips. First, be aware that short-term and long-term capital gains are taxed differently in each state. So, if you're considering cashing out an investment, it's worth checking if waiting just a little longer could save you money. Next, when investing in mutual funds, keep in mind that all investors are considered owners for tax purposes and are liable to be taxed on short-term gains. Since mutual funds trade shares frequently, this can result in higher short-term gains tax rates. It's also important to understand the difference between net and gross sums. Always ask whether the amount being quoted as a return on investment is the net sum after taxes and fees, or the gross sum before deductions. This will give you a better idea of the true quality of the investment. Lastly, look for investment options with low fees and taxes. Index funds are a great option because they don't have expensive investment fees. Instead, they're composed of stocks from an index, like the S&P 500. These stocks are held for longer, reducing your exposure to the higher short-term gains tax rate. By understanding taxes and fees, you can make smart investment decisions that will help you grow your wealth more effectively. Number 5. Why diversifying your portfolio is the key to protecting your investments. Have you heard of the principle of diversification? It's the 4th principle of the core 4, and it's essential for protecting your investments. Diversification is the financial equivalent of not putting all your eggs in one basket. By having a diverse portfolio, you'll be able to safeguard your investments against changing trends and market crashes. It's not just about investing in different stocks or assets, but also across different markets, countries, and currencies. There are 4 ways you can diversify: across different asset classes, within asset classes, across different markets and countries, and across time. Investing in multiple asset classes such as stocks, real estate, and bonds is a great way to diversify, as is making multiple investments in the same asset class. Remember that the financial markets are global, so look beyond your country's borders, and always add capital to your portfolio on a regular basis to improve your chances of latching onto a new trend. In short, diversification is the key to protecting your investments. So, don't put all your money in one asset class. Start diversifying now. Number 6. Why relying on instincts can lead to bad financial decisions. Our instincts can sometimes lead us astray, especially when it comes to making financial decisions. This is because our brains are wired to react to losing money as if it's a life-threatening situation. Our natural response is to withdraw and escape, even when it might not be the best decision. That's why it's important to have rules and checklists to guide our financial decisions. A good checklist can turn our decision-making process into a strict and reliable discipline. Just like pilots have long checklists before making important decisions, investors should have a checklist to refer to before making any investment. One great example is Paul Tudor Jones and his 5-to-1 rule. He would never invest without first referring to his checklist, which includes questions about risk to reward balance and expected return ratios. So, before making any impulsive decisions, refer to your checklist and ask yourself the important questions. Remember, investing is all about discipline and making rational decisions. And also remember, the key to successful investing is to start early, invest regularly, and be patient. By investing in a diverse range of assets and reinvesting your earnings, you can take advantage of compound interest to build wealth over time. We hope this video provided valuable insights and information for you. What type of investor are you? Risky or a safely calculative? Let us know in the comments. And if you learned something new from this video, make sure to hit the like button and subscribe for more videos. Thank you, and until next time.